In this video, we're going to discuss deferred tax assets. So deferred tax assets are increases in the amount of taxes you're going to save in future periods due to a temporary timing tax difference, right? So temporary differences are about timing, when revenue is recognized for book purposes, for tax purposes. There's some kind of difference in timing between tax and book, which basically means that you're going to have lower taxes in future periods as a result of this deferred tax asset. For example, let's say in the current period you have income tax expense of $80, but the actual income tax payable that you have to pay to the IRS is $100. And so you're going to have some gap here, some plug that you need to make your debits and credits balance. So you're going to have $20 of a deferred tax asset. You'd have a debit there. So that means your deferred tax asset is increased by $20. So in the future, you're going to have that benefit through lower taxes. Let me give you a more comprehensive example, and I'll show you some journal entries that'll make a little more sense. So let's pretend that you are a landlord and you rent a house out to a fraternity for $3,000 a month. So that's what you do. You rent houses and properties and apartments. So you rent it out to this fraternity. Let's say you rent it out to the guys from the movie Animal House. You rent them a house for $3,000 a month, and your tax rate is 40%. So now we've got a situation where let's pretend that they pay you in year one. They give you, so they're supposed to give $3,000 a month, so $36,000 would be your revenue for book purposes. But let's say that they pay you the beginning of next year, that extra payment, they pay it before year one is over. So let's say on December 30th of year one, they pay you the next year's rent, right? So you've received the rent in advance for next year. So you actually get the amount of rent collected in year one is $39,000. $3,000 a month for the first year, but then you get the next month of the following year, you get that. So you actually get 13 payments of $3,000, okay? So for book purposes, we would only say you only recognize what you have earned, right? So your book revenue is what you've earned, and you've only provided 12 months of rent to them, right, or housing to them. So you're going to only recognize $36,000. And so for book purposes, that extra $3,000 would be unearned revenue, right, which is a liability. But for tax purposes, when you receive that rent, it is taxed. So your tax revenue is $39,000, even though for book purposes, because we're only thinking about what's earned, it's $36,000. So your tax revenue is higher. So that means the excess amount of revenue for tax relative to book purposes for year one is going to be $3,000, right? So let's assume that your pre-tax book income is your financially reported income after computing expenses, all the damage that people from Animal House do to the house and everything is $15,000, but your taxable income is going to be $18,000. Why? Because we've got this temporary difference of $3,000, right? So they prepaid some of the rent for the following year, and for taxes, when you receive rent, you pay tax on that rent even if it hasn't been earned yet. So taxable income is $3,000 higher than the book income for year one. Now in year two, this is going to reverse because they already prepaid for that 1 month, so they only have to pay 11 months for year two, let's say, and so they pay $33,000. But for book purposes, you still recognize 36, right? 12 months times 3,000. So now it's actually 3,000 less. The tax revenue is 3,000 lower than the book revenue. So now it has reversed. It is reversed, and our taxable income is 12,000. It's 3,000 lower than the pre-tax book income. So this has reversed. What do I mean by when I say that the timing difference is reversed? Well, think about it this way. Either way, they paid you $72,000 in rent, right? So they paid you for book and tax purposes. You ultimately recognize $72,000 in rent over the 2-year period. And the excess of tax over book, the difference is they equal out to zero because it flips back the next year, right? So it's just a timing difference. And so each way you're going to have $30,000 of book income, $30,000 of taxable income. So it's just a timing difference. Now, I want to show you the journal entries to show you how this deferred tax asset would be recognized. So for year one, what we're going to do is we're going to have to debit income tax expense, right, for $6,000, okay? And then Well, let me show you. So let me just show you where I got this number. So you're going to take the 15,000, right? That 15,000 of pre-tax book income. You're going to multiply that by your tax rate. Remember, your tax rate is 40%. So 15,000 by 40%. That's where I got this $6,000 number. That's your income tax expense. Now, your income tax payable. Now, instead of using pre-tax book income to calculate income tax payable, we're going to use taxable income. So now we're going to say 18,000. We're going to take the taxable income of 18,000 times 40%. That's going to give us the income tax payable. Now, you see there's a difference. Income tax payable in year one, we're paying more tax than what our actual tax expense is. Because the tax expense is thinking about accrual accounting. It's thinking about unearned revenue, right? But tax payable is saying, hey, we're counting that extra $3,000 payment you got, right? So that is going to, we say, okay, we've paid, you can think of it as like we paid the tax early on that. Right? We paid the tax early on that $3,000, so we have an asset. Remember, an asset is something with future economic benefit. And so by prepaying the tax on that revenue, we didn't do it voluntarily, we were forced to do it, but even so, that $3,000 times the tax rate of 40% gives us a $1,200 deferred tax asset. Now, in period 2, this is going to reverse, right? So income tax expense is still going to be $6,000. Why? We take our pre-tax book income of $15,000, so we got $15,000 times 40% again. Now, for the tax payable, the actual check we're cutting and so forth to the IRS, if we can think about it like that, we say, okay, well now it's $12,000. 12,000 times 40%. So now we're in a situation where it's flipped. Our tax payable is actually lower than our tax expense. It's $4,800 instead of $6,000. Before, in the first year, the tax we pay was higher than the income tax expense, and now it has reversed. So when we say temporary tax differences reverse, that's what we mean when we say that they're reversed, right? So first the tax expense was lower than tax payable. Now the tax we're paying is lower than the income tax expense. So now what we're going to do, we have to reduce this deferred tax asset account, right? We had the future economic benefit, but now it's reversed, and so we no longer have that benefit. We enjoy it this year. So we credit deferred tax asset by $1,200 to reduce it. Okay, so now because it's reversed, let's assume this was the only temporary tax difference for your firm. So then if we were to think about a T account and we say deferred tax asset, we would have went up in period 1, we would have said debit it for $1,200, and then in period 2 we would credit it for $1,200, so it ends up at 0. So the difference, this temporary timing difference of when that revenue was recognized for that extra payment that you received before you'd actually earned it, it was taxed immediately for tax purposes, but for book purposes, you didn't recognize it until it was earned. It led to a temporary timing difference of when you recognize the tax and pay the tax on it, but it ultimately reverses, and so that's why our deferred tax asset goes to 0.